Thank you very much for including this paper in the program. It has been a great conference. I'm really happy to be here, and I'm particularly interested in topics of FX, so it's a conference I really enjoyed. So I'm going to talk about this paper that tries to understand CIP deviations in emerging markets, and a little bit of the motivation is that CIP deviations in emerging markets are very different than the ones in advanced, not only because of magnitude, but also the dynamics. Typically, they are opposite to what happens in advanced economies. So given the importance of CIP deviations, we wanted to try to understand why this happens in emerging economies. Right? So as I was saying, these deviations can be very significant. So here we're plotting the 3-month cross-currency basis across time for 20 emerging markets, 20 emerging economies. And what we see is that they are huge. They are like 100 basis points on average. They are very volatile. They can be very negative. They can be very positive, so for the same country. And they also happened before 2008, so it's not necessarily related to all of the Basel III concerns and increases in financial costs. If something, in many emerging markets, actually those Basel III regulations have not been implemented yet. So it is not necessarily related to this. Now, here we are plotting the advanced economy ones. We're plotting it on the same scale so that you can see how it shrinks in magnitude. And roughly, I think it's on average 20 basis points. So they are very different. Unfortunately, given the scale, you cannot see that they are actually sometimes is opposite to what happens in emerging markets. But the dynamics are very different. It's not just a matter of scale, but it's also a matter of the dynamics. Now, given the importance of CIP deviations in here, CIP deviations are very important in general, as all of this audience already knows. But in emerging markets, something that is particular is that large banks, large firms, they don't have enough necessarily funding in the local economy. So sometimes they borrow outside, they borrow in dollars, and what they do is like they try to hedge. And what they try to do is borrow synthetically in the local currency, right? So what happens when CIP deviations increase, and this particularly happens in bad times in emerging markets, this synthetic cost of borrowing increases a lot at a particularly bad time, right? And it also makes monetary policy in these economies particularly weak, because when things are going wrong, this is when the central banks want to decrease rates. And actually, you have the funding cost of large banks and firms actually could increase because the synthetic cost of borrowing in emerging market currency increases. So given the importance of these CIP deviations, we're trying to understand them, and the fact that they are not really that similar to advanced economy means that we cannot just go to the advanced economy literature and try to understand it from them. So what we do is, in order to try to understand these CIP deviations, I think it's important to try to understand the supply and demand dynamics, right? On the supply side, yes, we think that there are some constraints that we are going to abstract, and we are going to put it in the model. And we are going to try to focus on forward currency demand, where we think most of the shocks are coming from, right? And this sort of like our contribution in the way that we see it is that it complements the literature, because most of the literature tries to abstract from actually modeling forward demand, and here we try to show the importance that forward demand has. More precisely, we argue that currency speculation, and thank you, Haonan, for the great introduction to this. We completely agree with your paper, and we find sort of that currency speculation driven by hedge funds and global investors, they are the ones driving currency demand in these economies, right? So you cannot, it's hard to imagine, for example, a pension fund in Japan trying to do something in Peru. Typically, these are large hedge funds that what they're trying to do is to earn the carry trade, or basically the UIP premium, the predictable returns here in the exchange rate market. And the way they do it is by doing trading in the forward market. Now, why in the forward market? The reason is that in many emerging markets, what happens is that because the central banks are concerned about exchange rate volatility in these economies, they try to limit all of what they think could be currency speculation, right? So they put a lot of restrictions on foreign investors on local currency bonds, on short-term currency bonds. So long-term bonds you can invest, but short-term bonds, it is very hard to invest. So we take these segmentations very seriously in the model, and we try to do a model that really reflects what is going on in emerging markets. So in our case, the intuition is that, okay, foreign investors really want to earn these predictable excess returns, and they cannot do it in the cash market, in the short-term bond market. So what they do is they can use the forward market to do so, right? Because in the forward market, you're long one currency and short the other one, right? So you can long the asset that you think is going to appreciate over time or has higher rate, and short the one that is not. So in this setting, what we have is that local banks are going to be the intermediaries for this, and what they're going to do is that they're going to charge the CIP is going to be like a premium for doing this arbitrage. It also reminds me of Angelo's paper in some way, right? So they are trying to get these CIP deviations. It's just the profit that they're going to have based on this intermediation. So what we sort of try to implement this intuition in a model. We try to ground it as much as possible to the emerging market setting and what actually happens there. And we validate our predictions from the model using two types of data. The first one is going to be micro-level data from Peru. We take advantage of this only one country here because we have access to all the forward contracts of all banks in Peru. So we can measure the quantities. We can measure like the exposures, right? We can see, okay, which are the foreigners who are coming here versus vis-a-vis like firms and so on. So we can measure a lot of who's on the demand side and their positions. But we also want to speak more broadly to emerging markets. So we also complement this with a panel of 20 emerging market economies where we can try to talk about the prices, basically on CIP deviations. And then we discuss also, so we do this in the paper. We also discuss more evidence on speculation and differences in advanced economies that I'm not sure if I'll have enough time, but just, so that's also in the paper. So this audience clearly doesn't need a review of CIP deviations, but what I'm going to try to just tell you here is that two ways in which you can interpret the same CIP deviations that is most common in the literature. So in the literature, the most common way of writing the CIP deviations is the cash dollar minus the synthetic dollar rate. Now, if we think about it in our model from an emerging market perspective, something that could be very natural way of expressing it is looking at the CIP deviations as the synthetic emerging market rate, also, well, I shouldn't use it, minus the cash rate. And the reason is that imagine you are a global investor and you cannot invest in the emerging market cash market because of these regulations that prohibit you from doing so. So if you really want to invest in this emerging market, what you do is you try to get the synthetic rate, right? So you lend at the synthetic rate. So if there's a lot of demand from foreign investors to try to invest in the emerging market currency, CIP deviation should be negative, right? This should push the synthetic emerging market rate down. Another way in which you can think about this, and this is equivalent to the advanced economy literature, is just changing reshaping, changing the position of the different variables. But a different way of also thinking about it is from a local bank's perspective. You can rewrite the exact same equation, but in this way, a local bank, who imagine is an intermediary, is the dealer here, how from his perspective, for example, if they have a lot of demand on dollars forward, so imagine the foreign investor really wants to demand dollars forward, right? They want to retrench for emerging markets, they want to have more dollar forward, then you can think about the CIP deviation as the price at which the local intermediary is willing to sell these forwards minus the cost of unwinding it in the spot. The more demand that they have on the forward market, the higher the CIP deviations. All right. So now let me dig into the model. So our model has a forward market and a spot market. In the forward market, the first agent is the global investors. And something that is important is that they try to to obtain these predictable excess returns by just using the forwards, because they cannot use the spot, the cash, the short-term bonds, right? And why not? And here there's a lot of evidence. So we read like evidence on tons of emerging markets. We went into the different central bank websites and tried to understand the restrictions. So just as an example, for example, Peru puts a 4% fee over the notional on investing in these short-term securities on the central bank certificates of deposit. Then you have India that has quotas. You have Indonesia that has put like that prohibits from investing directly in the short-term rate. In the secondary market, they have some withholding periods that they have to hold. Brazil has a 6% tax. There are similar restrictions in Chile and Colombia, and the list goes on. So there are tons of restrictions where investing in the short-term bond market is really prohibited. Not only that, there are some restrictions on borrowing in the local currency, but on top of that, it's really easy to go to the forward market, right? They can just go to the forward market. They already have a long leg and a short leg. They can it is netted, so it's like very little counterparty risk. So it's pretty easy. So they go there, and what they do is that in our model, they are trying to their maximization problem is a mean variance utility function, where they're trying to maximize these returns. The return, for example, of being long the emerging market currency is just a function of the expected return of being long relative to its variance. And they have a risk aversion parameter here, which we'll put it as gamma later. And what we can see here is that we can decompose the expected return of being long the emerging market currency into UIP plus a CIP deviation term. But if you think about it, whenever the global investor really wants the emerging market currency, here it's H, their position. So if they want to increase their position in the emerging market currency, actually what we're going to see is that the synthetic rate is going to be pushed lower in equilibrium when we look at with the global banks. So it's going to push down the synthetic rate relative to the cash rate. So actually, whenever they want to hold more of the emerging market currency, the CIP is going to be negative. So the CIP here is a cost in some way to the global investor, right? So we have here going to be the global investor, and we have also the local intermediaries who trade in the forward market and in the spot market. Now, a key feature of emerging markets is that the local intermediaries, they cannot have exchange rate risk. They can have very little exchange rate risk. This happened after the Asian crisis, right? All of the central banks try to manage exchange rate risk of the local banks, so they basically put it almost at zero. So we take that and we assume that then the local intermediaries cannot have this exchange rate risk, which means that the whole function that they have in terms of the forward market is to do the CIP arbitrage, right? And at the same time, they have some position limits, so they cannot do infinite position, and this relates to different costs that they have. This more aligns to the supply side constraints that there are in the literature, and they cannot do infinite amounts, and therefore will charge for it, right? So this is like the intuition of the model. So what we have is that the amount of dollars that the bank is going to supply, which means is the same as the amount of emerging market currency that they're willing to hold. They hold the emerging market currency, sell the dollars, right? It's going to be a function that is positively related to the CIP and inversely related to the participation costs, right? So the higher, the more the global investors demand more dollars. If they demand more dollars and the intermediaries have to supply these dollars, the CIP is going to be positive, right? This typically, in equilibrium, we'll see that the forward price at which they want to sell, the banks are going to sell, is going to be higher than the cost of unwinding it in the spot. And you can rewrite the CIP as that, right? So we see that the supply of dollars is going to be increasing in CIP deviations. So from those two sides, we can actually put the supply and demand curves on a graph, and it's a very simple negative slope demand curve and positive slope supply curve, where the amount here is the amount of dollars, and you have as a function of CIP deviations. So what is one of the propositions in terms of our paper just comes from this, okay, is that what we see is that as global investors have that local intermediaries' dollar position in the forward market is negatively correlated with the global investors' position. So, and we are going to confront that with the Peruvian data. So let me go with that first prediction. Here's the local intermediaries' position. And what we see is that it is inversely related to the global investors. This means that the global investors are actually the main participants here, because this was not trivial, right? Because the local intermediaries their positions is mostly what happens with the global investors. So they are the main players. There can be other players that are trying to hedge, like local firms that I said as a motivation, that trying to borrow dollars from outside and borrow synthetically in emerging markets. They try to hedge, but like the main player here are the global investors. And what happens is that the local intermediaries and the CIP deviation, which is the red line, are going to be negatively correlated, because the local intermediaries are going to set this as a charge to take these positions, right? And as we can see, here we're plotting the CIP, the local intermediaries' profits, and we see that they are always positive of intermediating the CIP deviations. And we could measure this very clearly because we have all the money market rates for each bank in Peru, all of their positions, exactly at what time it happens. We have even the spot rate what was the spot rate when they closed the deal. So we can actually measure this very precisely, and we can see, we try to measure in two different ways, and we see that they always have profits. Now, an application of this is what happens under global risk aversion, right? So under global risk aversion, what you see is that if the foreign investors are investing in your country, if there's more risk aversion, they will want to retrench. What does it mean, retrenching? It means demanding more dollars forward. When they demand more dollars forward, so their demand increases, and what we would expect is that the CIP deviations would increase, as banks are going to be charging for supplying these dollars, right? And what we do is, like, we look at empirically, we first, to look at quantities, we look at whether these global investors retrench under risk aversion. So what we do is we run some daily local projections on the quantity held by the foreign investors, or the change in the quantity held by foreign investors vis-a-vis the VIX. And what we see is, and here we're plotting the coefficient, and these are all these trading days, before and after. And what we see is that at the time that the VIX shock comes, what we see is that global investors' position in dollars increases, just as what we see in the model. We also had it for banks, and it decreases basically on the same amount. And what we also look for all emerging markets, and what we see is that the CIP deviations increase with this jump in dollars held by foreigners, right? So for emerging markets, we didn't have the position for all of them, but I just wanted to show that this is a common feature for CIP deviations in emerging markets, and this happens the same way in Peru. Now, I don't think I have time. The model has like CIP and UIP predictions as well across countries, and here we have different effects. And how much time do I have? Okay. So, let me skip the other part. But so what we see is, one feature of our paper is that we think that speculative demand is important, and we have different pieces of evidence. And Haunan paper is also one of them, But one part of evidence is that, if you think about these foreign investors trying to if they were hedging, what you would expect is that whenever they invest in emerging markets, right, they are investing and they're holding emerging market currency. So you would expect for them to be buying dollars all the time, regardless of the period. All the time should be positive. But if we look at the positions of local global investors, we see that many times it has been negative, which means that even in net, some might be able to hedge, even in net, it's incredible that all of that the possible hedging is even offset by speculation, right? We also see that whenever foreigners buy soles bonds in Peru, they are not engaging in forwards, so it's basically uncorrelated, right? And more predominantly, what we see is that as it becomes more profitable to be short dollars, which is here, the expected return on the emerging market currency, then there are more short dollars relative to when it's less profitable, right? So they are responding to this profitability. Now, they are very different in advanced economies. So here I haven't talked much about the advanced economies, but if you see the CIP deviations under global risk aversion, they actually decrease. In advanced economies, it increases. And this is the same plot that I showed you before, CIP deviations that jumped in emerging markets. Here we see that they decrease. And what we think is partly the size of the magnitude of the CIP deviation, the difference is the levels, is basically because of segmentation. That's what we think. But the dynamics is also different. So the dynamics, a key important consequence of our paper is that given that global investors are so large for that small economy, those are the ones driving the forward demand and changing CIP deviations. In advanced economies, it's different. And what you can have, and I think, Amy, you also have a paper on this, like it's that you have all of these big like local investors in these big economies that whenever there's some risk, they might want to retrench. But retrenching, what it means is that because they were investing outside, investing in dollars, retrenching means demanding more of their of their advanced economy currency, right? So that has different properties on the CIP deviations. Now, so just to conclude, we try to highlight the role of speculative demand in emerging markets, and we think that the demand of speculators is really key to trying to understand what are the shocks to which these economies are responding, right? And this is really, and we're thinking that this is pretty important to understand just because of the importance of the synthetic peso borrowing during recessions, right? So I'll leave it at that, and thank you so much for your time, and to the organizers.
Thanks very much for putting together this brilliant program. And so I had this discussion over lunch, so I think it's actually great the way the sessions are structured. So this paper really follows very nicely to the paper before. Right, so Lorena did a great job explaining and presenting the paper, so I'm going to try and be very, very quick and sort of highlight where I would put the emphasis. So it's CIP deviations in emerging market currencies. What drives them? And in a way, the answer is very strong, right? It's speculative demand by global investors that drives it. And in a way, the paper before, Hoan said, it's the speculators that absorb the hedging demand. So in a way, already there's things kind of line up, but it's a very different language, right? Sort of here, it's the speculators that drive, and before it was the speculators that absorb, okay? So that there seems to be a little bit of a tension, okay? Now, this kind of goes through the fact, and this is again very similar to before, that these global investors here, they have to rely on forwards. They can't go into the cash markets at all. There's a model, and the model predictions are really nicely confirmed in the data, right? So the balances of the local intermediaries really nicely mirror the positions. It's a nice graph from Peru. You're going to have a link to high expected excess returns. What's also going to be important, UIP and CIP deviations are negatively correlated in the cross-section. You see that in the data. In the model, it's hardwired, and I'll show you a bit more in detail how that works. And then there's this issue of what happens during crisis periods. Okay, so we have the cross-currency basis. I always mess these things up, and these little things to remind me of how stuff works. For AI, so advanced economies, we often have these negative CIP deviations, and sort of some of them are positive. Usually you have the big spikes on the negative side. For emerging markets, it's a little bit all over the place. So we've seen that from Lorena's graph as well. Okay. The assumptions in the model are really key to what we're actually going to get out of the model, right? So there's strong market segmentation. So the speculators can only be in the forward market. Now, in the data, or in reality, right? So the fact that there is market segmentation leads to sizable non-NDF markets in key emerging market currencies. And then sort of a second important assumption is that the local intermediaries basically fully hedge their exchange rate risk. And again, this is motivated by local regulatory requirements. Okay? Now, the global investors kind of drive everything, right? And so the way to think about is then the local intermediaries, they satisfy this forward demand. And so here, that's sort of my little things to remind me of. So for positive CIP deviations, they're going to sell US dollar forward. For negative CIP deviation, they're going to buy US dollar forward and sell the home currency, okay? Right, and then there's some sort of additional players in the market to close the model. So here's what's sort of the holdings or the demand from the speculators. And what you can see is it's really driven by sort of how much do we, expect to make from that trade, right? And so if you want to motivate that with, speculation and carry trade, I guess we all agree that emerging market countries have higher interest rates than the US dollar. And so if you think I want to do carry, then usually I go long the emerging market currency, okay? And so in order for investors to take long home currency, short US dollar forward positions, we need to have a positive expected excess returns, right? Now, there's only, in order for the forward markets to clear, so we're only going to have the local intermediaries who take the opposite side of the trade, okay? Now, they're going to be compensated by CIP deviations. Now, the expected excess returns are the sum of these two things, right? And so and Lorena highlighted this as well, right? So for the speculators, if we're going long the emerging market currency, then this is a cost for the speculators, right? Because that's the compensation for the local intermediaries. And in order to offset this cost, we need to have like pretty big UIP deviations for the speculators to still make money, okay? And in a way, well, it's borne out in the data, but this already hardwires that the model is going to predict that we're going to have a negative correlation between UIP and CIP deviations. One has to be positive, the other one has to be negative, or vice versa. Okay? And so in a way, when I was trying to wrap my head around the model, sort of there's also additional model implications in my head. In absolute terms, the UIP deviations must be greater than the absolute CIP deviations because they need to overcompensate the global investors for what's going to happen, whether or not they're going to take a positive or a negative position, right? And also, positive CIP deviations, they're going to imply like it's a very strong depreciation of the emerging market currency, okay? Right. Now, we're going to have, this is from another paper, so one thing you see clearly is that the CIP deviations, they can be positive or negative, okay? And in a way, that's sort of, given what we have here, this sort of should pin down whether speculators go long or short the emerging market currency, right? So that there's a direct link according to the sign of the CIP deviations, okay? Now, there's a sort of a sideshow in terms of the comment. These guys argued that sort of you shouldn't take sort of the standard way, you should purify them. In the paper, they argue at the short end that doesn't really matter. There's also, seems to be, if you can look at CIP deviations onshore, offshore, there's sort of quite a time variation of that. Again, so in the end, I figured that's a little bit of a sideshow, but might be something to kind of look at and sort of tick off at some point in the paper. And so kind of looking at it is, what are we trying to do? Is this a model that's focusing on emerging markets, or is it a model that's trying to explain CIP deviation. In a way, it's a model that explains CIP deviation in emerging markets, right? So I guess one thing I would like to see whether it's possible to relax assumptions a bit and get sort of reasonable predictions, right? So can you have a model that nests both AI and EM? So Lorena showed that if we remove some of the restrictions, then we get to 0 CIP deviations. But that's kind of counterfactual compared to what we're seeing right now in advanced economies as well, right? Also, even in emerging markets, there's sort of a sliding scale, right? So not all of them have complete segmentation. So if you sort of can relax this a bit, can you exploit that a little bit more empirically? And then these additional implications that I mentioned before that I think seems to be fairly hardwired, is there something that you can show in the data as well, especially about what do we expect in terms of appreciation and depreciation of the emerging market in the emerging market currency, okay? Related to that, so we're going to have this negative relationship between UIP and CIP deviations. For advanced economies, it also goes the other way. So there's also a bit of a question to what drives that mechanism. In the model that we have, I would say it's hardwired. But in reality, there's no reason, or in reality in the data, depending on what markets we look at, that is not necessarily the case. Okay. And then, so given that, right, sort of the answer to the question is what drives these CIP deviations in emerging markets, it's speculators. So I would like to understand a little bit more, how does speculation work in those markets? As in, right, so, we do have this borrowing in synthetic domestic currencies, a key financing channel for these local US debtors. But here, that requires these financial intermediaries to provide US dollar. And so that's sort of consistent with these positive CIP deviations. And so I guess what I'm trying to say here, is there really no room for sort of this hedging motive that in the model is, I guess, completely pushed to the side? If you remember the nice graph from Peru, so about half of the sample period, we're going to have positive CIP deviations for Peru. That is inconsistent with speculators going long the emerging market currency, right? And so what does that mean? And then when it comes to speculation, how is that happening, right? Sort of, who is that? How active are these global investors in EMs? And the paper before, I guess, shed some light on that. So I didn't know that paper before. Now the data is, I think the data is super cool, but then looking at, right, sort of, if you look at FX derivatives from the BIS statistic, it's 5.5 trillion. Peru is sort of 500 million, right? So it's in a way it's tiny, but it would be interesting to see what fraction of that 500 really goes to speculation and who does that in particular, okay? So this is sort of the point about how do we really distinguish the speculation from hedging. In the model, there's no room for it, right? Because it's really only the speculators that trade in the forward, okay? So let me conclude. I think it's very interesting. I've really enjoyed reading it. I would like to understand a little bit more what that means in terms of speculation. Since the big answer of the paper is it's really the speculators that drive CIP deviations in emerging market currencies. The model works, right, with the stylized fact, but to what extent is there really no room for a hedging motive, especially given that we have quite a bit of periods with positive CIP deviations, which in the model imply something very strong about how these speculators take position. And given this super rich data, so I guess the question is, can you tell us more about how sort of speculation works in emerging markets? Thanks.
So just a quick remarks. So I think like the model, I don't think is hardwired, that UIP and CIP is just natural derivation from we just take a utility function that we're maximizing profits relative to risk aversion, and that's something that comes naturally, like the trade-off between CIP and UIP. Now, when CIP is positive, it's just that we cannot distinguish if the foreign investors are speculating or hedging. It doesn't mean that they are not speculating. They could be speculating if they think that the currency is going to depreciate by more than interest rate differential. And indeed, Peru put some regulations thinking that they were speculating against the currency at one point when CIP deviations were positive. And indeed, when we think that just one of the evidence we thought about that they're doing some speculation here was that the CIP deviations at some point were negative, because if they were, speculation requires that they are positive all the time, right? So just wanted to clarify that, and so just with maybe now, if I have more time, I can take some questions, just to, yes.
I was wondering, how do you think about credit risk in your framework? So these, my understanding is that your global investor are taking position in long or in local currency for local currency bonds, and they do through the foreign exchange market. But those bonds ultimately have credit risk, and has been documented to carry over into the CIP.
Okay, just a short answer, or yeah, maybe I can collect. Yeah.
I think the insight from Gino's discussion this morning is that demand would only make a difference if the supply curve is upward sloping. You mentioned that in the emerging market space, there is no balance sheet cost per se, but there are potentially other types of costs. In particular, CIP is only a no arbitrage condition if there is freely available arbitrage capital to take advantage of that deviation. But you mentioned that it's quite the captured audience who could actually do the CIP deviation, the local intermediaries. When there's such a small set of local intermediaries, one would worry that there are market power at play, that potentially the supply curve is rather difficult to estimate. So it would be really interesting if you can shed some light on the interaction between supply and demand in driving CIP deviation in emerging markets.
So in your data, are these all financial investors, or do you also have non-financial investors in Peru in this case? Because one would certainly like to, moving beyond CIP, but more towards just real outcomes, to understand the extent to which the factors we've identified are raising costs or not to the agents engaging in international trade that are suffering from these deviations or not. No? So I'm thinking here of the work of Liliana Varela and others documenting what happens in Chile and whether your results are consistent with what she finds in terms of the effective costs of doing engage in international trade and hedging these positions.
Yeah. Okay, well, thank you very much for the questions. Regarding credit risk, yes, we thought about it. And here we're talking about short-term, the predictable excess returns that we're talking about on CIP is on the very short end of the curve. And this is where the global investors cannot really invest. Now, taking aside, there are some literature I know about thinking about CIP deviations in emerging markets being the cause of the CIP deviations. We don't think this is the case, because first of all, it would require the CIP deviations and the global risk aversion to be negative. Now, the rationale, the way you can think about it, is that credit risk is embedded in the paper, in the cash, right? So you have the synthetic emerging market rate minus the cash rate. At bad times, when things are wrong, you would demand a higher cash rate if there was a credit risk, and that would imply CIP deviations to be negative. If something, they are actually the opposite. They jump under global risk aversion, and they are negative when the foreign investors really want to invest there. So we don't think this is playing a big role, and we are also thinking about the very, very short term, so when there's very little risk. Now, Amy, thank you for your question about demand and supply. So we have an upward sloping supply curve. Maybe we can talk later about it, but because they have some financial constraints as well, they're the local intermediaries, right? So, but I understand that there could be some tricky things to try to estimate it properly, but we right now we are abstracting, but maybe we can talk more more about that. I would love maybe your feedback on this a bit more. So thank you very much for your question as well of like what is the role of non-financial investors. We have data on this on terms of the forward contracts. So we see that we have the forward, so what we observe is that all of the forward contracts done by local intermediaries with anybody, right? And we actually see who's the counterparty. So we observe on non-financial firms, we can see exporters, importers. At one point, for a different paper, I emerged who was an exporter, who was an importer, and indeed and we can effectively even measure the potential charges per customer at the same time. So we have very rich data on that, and for a different paper, I had seen like that these are affecting how the pass-through in here, but I didn't go much further, right? But it's true, it's a very good, nice way in terms of putting in terms of real costs. So thank you very much to everybody.